So today we're going to look at income securities. Now, income securities is quite a broad range of different types of investments, but they all basically sit inside what we call the fixed interest or debt sort of side of things, which is a relatively, or generally considered to be a relatively secure or safe area of investment. Now, that's not to say that you can't lose money in this area. It certainly is an area where it's quite possible that significant and even total losses can occur. But generally, the credit worthiness of the instruments is largely the risk as opposed to the short-term volatility. So, as a general rule, it covers everything that's a debt from one organisation or institution to another. And depending on the nature of the institution or the company or the government or semi-government offering the debt, determines a little bit around what interest rates are applicable and also the relative safety or the credit rating of the instrument. But increasingly over time, we've started to see more and more of these instruments being issued, particularly by financial institutions and insurance companies, to particularly comply with a lot of the changes to regulations that came out of the GFC. So let's start by looking at the range of different types of instruments. So right up at the very sort of safe or lower risk end of things, we have what we call government guaranteed. So not only is this instrument guaranteed by the issuer, but it's also in some way, shape or form guaranteed by a government. Generally considered to be the safest because it's generally assumed that a government can pay its bills as well, if not better than anybody else. So we then move down to things like covered bonds and senior and unsecured debt. So these are instruments that are normally, guaranteed by assets or at least by charges over the company or itself. So tend to be relatively secure. But it's important as we move down this this list, if you like, to understand that each ranking is a complete level. So, for example, senior secured debt holders don't receive any of their income or any of their capital return in the event of a wind-up of a business unless all the covered bonds have been repaid. Similarly, the subordinated debt doesn't get anything until all these guys have got all their money. Hybrids the same, and our shareholders, those who own the equity in the business, don't receive any of their entitlements, be it dividends or return of capital, until everybody's received theirs. And therefore, shares tend to be what we call the riskiest end from a credit perspective, the end of a particular company or institution's capital issued. So, most of the instruments we see though these days listed on the stock exchange sit in what we call this hybrid sort of section. So just sort of one move up from equities. Now again, these things are largely, as I said, debt orientated instruments that are issued normally for around $100 and provide a particular return based on interest rates as opposed to the profitability of the company as a share would. So these rates are normally floating rates. They're normally move in line with prevailing interest rates and normally a margin over the underlying what we call bank bill swap rate or the rate that banks pay between each other. So those instruments will generally be relatively secure in terms of the capital value. They can move a little bit in terms of demand and market movements, but generally because they'll be guaranteed repaid at a particular point in time for a particular value, they're much more like a loan than they are like an underlying share. Most of the time. Now the issue here though is with most of these instruments they have a number of conditions that can come into play in certain circumstances, and a good example of this is a recent issue by the ANZ, which for all intents and purposes sits very much in this hybrid sort of vein. Looks like a debt from the ANZ to the borrower, but contains a number of interesting clauses or conditions to help ANZ better comply with the new banking regulations that came out of the GFC. And as a result of those new banking regulations, they set more stringent rules on the amount of capital that the bank must hold. And so these instruments offered by ANZ, for example, had some conditions within their structure that allowed them to essentially move up and down this sort of ranking curve depending on the requirements of ANZ meeting these new banking requirements. And in fact, there's a clause that allows ANZ essentially to wipe their hands and walk away from them if APRA, being the banking regulator, determines that it's required for ANZ to meet its obligations under these new banking regulations. So at the moment, ANZ is a long way from needing to do that. But if another credit crisis was to happen during the period that these things are on issue, there's really no way of knowing or no way of judging just how likely those particular clauses could be called in. And rather than sort of sitting up here above the shareholders in terms of a ranking, we could find that these instruments are suddenly worthless because ANZ's taken the position to run them to zero because they're allowed to under the conditions of the PDS, and so suddenly they're now effectively outranked by the shares in ANZ, and the shareholders still get their return. So there can be a number of these sort of not hidden clauses, but conditions sort of built within these instruments that can substantially change the risk-return nature of these instruments depending on certain conditions. And those conditions themselves, given some of the changes in recent times coming out of the GFC, can be very, very difficult to sort of work out how likely and what the relative impact of them may be. And as a result of this, it's just another reason why we generally don't like to hold these instruments directly. We much prefer to take a managed approach where good, well-qualified professional managers can have a look at not only the new instruments that are being issued in the market and where they may actually sit under certain conditions, but also how they compare and should be valued compared to existing instruments in the market as well. And so often the best way to take advantage of a new issuance in an income security is in fact to buy an existing one that's now more attractive on a relative basis than it is to buy the new issue from Westpac or Commonwealth Bank or whatever. So this is just a quick overview in terms of some of the issues that we can come across in terms of hybrids. It is a very, very broad area. It covers a lot of different types of instruments. If you've got any questions, as always, make sure you drop us a line. But hopefully this video has given you a little bit of an insight into some of the complexities that can occur in these instruments that collectively might all seem like they're very similar, but in fact have very, very different characteristics and can have some substantial stings in the tail.